Know Your Company, a show designed to give regular investors powerful and actionable insights into the fundamentals of a single NSE-listed company every day. What we do here is we pick a company and we go through a couple of parameters that we have designed for every company. Today on KYC, we are speaking about V2 Retail, and the parameters that we're going to talk about is first one being the income statement. Then we have the balance sheet. Then we'll talk about the cash flow statement as to how the company is performing in terms of its cash flow statement. We'll also talk about the return ratios. We'll also talk about how shareholding pattern is panning out for the company. Of course, what the analyst recommendations are and what the street cred looks like. And the valuations where peers are concerned. All of these things we'll deep dive into and see how things are panning out for V2 Retail. To start with V2 Retail, just a brief about as to how the company has panned out so far. It was incorporated in 2001. The company went public in the year 2007. It primarily operates in Tier 2 and Tier 3 cities. The company is a chain, it operates under a chain and the stores under the name of V2 Retail, and it offers apparel as well as general merchandise, and it's catering to the entire family. So there's menswear, there's women's wear as well as kids wear. It overall, caters to the neo middle class as well as the middle class. It has in-house product development team. The company operates currently around 160 stores that are spread across 18 states and 130 cities. It also is a top retail, one of the top retailers in the Tier 2 and Tier 3 city play. And the total retail area for the company is approximately 17.2 lakh square feet. In terms of the overall production, it has an in-house product development team, as I mentioned earlier. It has a state-of-art manufacturing facility in Noida and Bihar, and it also has a centralized warehouse and distribution system located in Gurgaon. So this is the brief overview of the company. Now, moving on to the overall metrics that I was talking about, the first one being the income statement. Now, in terms of how income statement has panned out for this particular counter, in terms of revenue, the 3-year CAGR for the revenue has been around 29%. 9 months FY25 numbers stood at 1,386 crores, which was around 1,165 crores in FY24. So 9 months FY25 has already crossed the number for FY24. In terms of EBITDA, the EBITDA CAGR for 3 years has been 45% for the counter. Margins have improved from 12.7% to 14.4% in 9 months FY25 as compared to FY24. And net profit has gone up from 28 crores in FY24 to 66 crores as of 9 months FY25. In fact, before FY24, the company was running into losses for the past 3 years. FY24 is when it turned profitable, and the profits have almost nearly tripled in 9 months FY25, and there's still one more quarter to go. So considering all of these metrics, we've given income statement a complete thumbs up, because 3-year CAGR for revenue as well as EBITDA looks pretty strong, and overall company turning into profitability and also increasing its profitability. Now, in terms of operational highlights, just a few operational metrics that all of these retail companies operate on. The average selling price for 9 months FY25 stood at 293, which has increased from 263 in 9 months FY24. Average bill value has also increased from 798 to overall 853. The MRP sales contribution has also increased from 85% to 91%, which is one of the reasons as to what is aiding the margins. Not just the bill value and the average selling price also going up, but this is overall aiding the top line as well as the margins for the counter. The sales per square feet has also significantly gone up from 862 to 1069. In terms of same-store sales growth, 9 months FY25, it stood at 31%, which has not been the case, in fact, for a lot of retailers which operate in Tier 1 cities and are much larger and have much larger operation of scale as compared to V2 Retail. In terms of volume growth, it stood at 43%. The store count is at 160 stores, as I mentioned earlier as well, and the retail area stands at 17.2 lakh square feet. Now, in terms of division-wise sales for 9 months FY25, the division is that menswear accounts for 39% of the total revenue. Ladies wear accounts for around 27% of the total revenue. Kids wear is around 25% of the total revenue, and lifestyle stands at 9% of the total revenue. So this is the overall breakup of income statement as well as how operational metrics are getting strong for the company. So big thumbs up there. In terms of balance sheet, that is our next metrics to talk about. Balance sheet, well, net worth has improved as compared to FY24. It has gone to 289 crores. The overall gross debt stands at 17 crore, and cash in bank, which was at 10 crores in FY24, stands around 4 crores in first half of FY25. But overall, the gross debt overall is at 17 crores, which is not a matter of concern, and which is why we've given a thumbs up where balance sheet is concerned. Moving on to the next metrics, cash flow, in terms of comparison of first half of FY25 to first half of FY24, cash flow from operations have significantly improved. It stood at around 54 crores in the first half of FY24, which has gone up to 94 crores in first half of FY25. However, the net cash flow position has slightly gone down, which was negative 2.6 to negative 5.5 right now. But it's important to note that overall, in FY24, they did turn net cash positive. So considering that how balance sheet will pan out in terms of net cash flow position for FY25, we can expect that this will also turn positive going ahead. Which is why we've given a neutral rating right now where cash flow is concerned. Moving on to the return ratios, the overall return ratios, we've given this parameter, and in fact this is the only parameter where we've given a thumbs down, because in terms of return of capital employed, although an increasing trend from 22 to 23 to 24 as well, which has been a significant jump from 3 to 11%. But generally, return on capital employed is considered to be better if it's near the 20% mark or above that 20% mark, which is why we've maintained a neutral stance, considering that there is an increasing trajectory seen in return of capital employed. Now, in terms of return of equity, that has turned positive, and in fact turned positive in a big way, which was a negative 4% in 2022. It has gone up to 11% positive overall in 2024. Moving on to return on assets, they have also been improving from a 2% in 2022 to a 9.5% in 2024. So overall, all the three metrics, that is your return on capital employed, your return on equity, as well as your return on assets, have been improving, but they are yet to come to the mark of generally a fundamental targets that generally a retail company has, which is why we've maintained our neutral stance. But having said that, return ratios on all three metrics have been improving for the company. Moving on to the shareholding pattern. Interesting shareholding pattern for the overall V2 retail. It's a well-held company. Promoters are holding approximately 54%, which they have maintained since March 22. It was around 54.6%, which has come down to around 54.3%. But they've maintained, promoters have maintained their confidence in the company, which is why it's a well-held company. The only negative part here is that FIs have been selling in the company. The FI stake in March 22 was approximately 6.4%, which has come down to 0.9%. So FIs are not showing confidence in the company, but DIs have increased their stake in the counter from March 22 to December 24. March 22 stood at around 1.5%, which has gone up to 6%. And overall public holding has not changed. In terms of public holding, it stood around 38.5% in March 22, which has gone up to 38.8% in December 24. So we've given this counter a neutral rating, considering that FIs have been selling, but overall it's a well-held company by promoters, and DI is also increasing their stake. We've given it a neutral rating. Moving on to the street cred. Overall, the stock performance of this company has been pretty good as compared to how benchmarks have performed. 1 month, the stock has been up 11% versus the 2% drop in the Nifty 50. In terms of the company's stock performance versus its 52-week high, it's 21% away right now from its 52-week high. 6 months, it's been up 40%. And 6 months, we've seen that the markets have not been doing well, but V2 retail has performed well. And this is because both quarter 2, quarter 3 performance performances for this particular counter were pretty good. 1 year, the stock is up almost 304%. And 5 years return for this company has been over 41 times. So overall, the stock performance has never been disappointing for this particular counter, and which is why we've given a thumbs up for V2 Retail. Now, considering valuations and valuations versus its peers, in terms of V2 Retail, the peers for V2 Retail could be likes of V-Mart and Vishal Megamart, which also operate in Tier 2, Tier 3 cities. We've also compared it to something like an Aditya Birla Fashion and Shoppers Stop, although they are not like for like or apple to apple comparison, but they operate in the same segment. So to compare it with something like a V-Mart or an Aditya Birla Fashion, the trailing 12 months EV to EBITDA still looks expensive for V2 Retail. It stands at around 35 times. But having said that, the PE, the EV to EBITDA for the particular counter is on a decreasing trend. If we see the Bloomberg estimates for the particular counter in terms of valuations, it comes down to 15 times in FY26 as per their estimates, which turns out to be cheaper than something like a Vishal Megamart, or it's in line with something like a V-Mart or an Aditya Birla Fashion. Shoppers Stop, however, is a little different from what these counters do. But Shoppers Stop is the cheapest one right now amongst its peers. But having said that, we've given it a neutral rating because, one, it's expensive right now when it comes to the 12 months trailing P. It stands at EV to EBITDA stands at 35 times in terms of EV to EBITDA. But it gets better in the next 2 years. It comes down from 35 times to 15 times. Moving on, in terms of analyst recommendations, we don't have a lot of analysts covering this company. There were 2 buys from 2 different analysts, 0 holds and 0 sell in the company, and an overall return potential of 36%. Now, the only reason as to why we have given a neutral rating to V2 Retail where analyst recommendations are concerned is because not a lot of analysts cover this particular counter. But overall, 2 buy calls given by the analysts who cover this. So this turns out to be a neutral rating where analyst recommendations are concerned. Now this brings us to the end of the 8 parameters that I was talking about. Let's take a count as to what total rating for something like a V2 Retail comes out to be. We've given a thumbs up to income statement, thumbs up to a balance sheet, neutral rating to cash flows, return ratios is the only counter which has had a thumbs down. And in terms of shareholding, it's a neutral rating. Street cred, a complete thumbs up. The stock has never disappointed its investors. Valuations is a neutral, and street coverage is also neutral because not a lot of analysts covering it. So overall, it comes out to be a 5 out of 8 rating for V2 Retail. Now, in order to take this conversation ahead, we are also joined by Akash Agarwal, who is the whole-time director of V2 Retail, who is joining us now. Akash, a very good morning to you. Pleasure having you on the show and pleasure talking to you again. My first question to you is, we've deep dived the company. We'll go to company specifics, of course. But, how are things panning out for retail sector right now overall? How is the industry seeing? What are the kind of headwinds and tailwinds that you're seeing?
Yeah, hi, thanks for having me. So we have seen very strong demand in the last 4-5 quarters, and we've been consistently showing a high double-digit same-store sales growth. And we've seen that continue into Q4 also. But it has also been because of all the different business model changes that we've done and all the different assortment changes that we've done. And I think it's working well for us, and hopefully the momentum continues.
And, Akash, with respect to the overall demand, we've seen that the past few quarters have been excellently good for you. I mean, the rural demand has really picked up, and this is the reason as to why your overall revenue has picked up quite significantly. How are you seeing the demand in Tier 2, Tier 3 cities play out for Q4 as well? And what's the outlook like once FY26 also starts?
So yes, we have changed the base quite a bit. So our base used to be about 68 lakh rupees revenue per store per month, and this year we're going to do more than 1 crore revenue per store per month. So it'll be very hard to maintain the same growth percentages, but in Q4 also and going forward, we are looking at a double-digit SSSG.
Double digit. So you've already done around over a 30% in 9 months FY 5 itself. Do you think that 30% mark will be breached going forward in FY 26 as well?
30% would be too optimistic a number. So what we are looking at going forward is around 10%. So anywhere between 8 to 10% on such a high base is good for us because it's a fixed cost business. And even if you add sales by 10%, you can increase profitability by almost 20 to 25%.
Right. And Akash, in terms of your expansion plans, because right now, you're spread across India, around 18 cities, 130 cities, sorry, my bad, and 18 states. What are the next, leg of expansion plans that you have from a longer term perspective, let's say by the end of FY 26 or FY 27?
So we plan to open 100 stores every year, at least for the next 2, 3 years. And when you talk about geographies, then about 70 to 80% of the stores we are planning to open in the existing geographies where we have a very strong brand presence in. But we are entering new markets. So we just opened our first store in Rajasthan, we opened our first store in Punjab, and we opened our first store in Andhra Pradesh. So what we do is we leverage data and we do a lot of data analysis. So when we enter new markets, we collect the data for about 6 to 12 months. And that gives us a lot of insights into what kind of assortment do we need to provide to the consumers there. And that really helps us in the future expansion in that particular state. But going forward, because in the next 5 years, we want to be a national level retailer, we are testing new markets and gathering as much data as possible so that we can be successful in the new market as well.
Right. And Akash, a lot of people operating in the textile space as well as retail space where clothing is concerned are talking about the Bangladesh plus one strategy. How are you viewing that? And do you think that you will also be expanding globally going forward, let's say 2 years down the line?
It's not in the near future. The plans are not there in the near future, but definitely once we feel we are strong enough and the model is strong enough, then we might think of expanding into international markets. But currently, I think India is big enough to have more than 3,000 stores, and we just reached the number 189. So there's a long way to go. So we're focusing on India right now.
Right. And tier 2, tier 3 cities, you surely have a strong hold. But what's the plan with respect to entering the tier 1 cities? Because probably that's where your overall average selling price might go up and margins will also go up. But at the same time, the urban demand right now is not looking very nice. So what's your plan with regards to the tier 1 cities expansion?
So whether we are present in tier 1, 2, or 3, our target customer remains the same. For example, we have almost, I think we have 9 or 10 stores in Delhi now, but we are very strategically placed where we know there's a lot of migrant or low middle class and middle class customers. So for example, in Delhi, we have a store in Mahipalpur, we have a store in Kapashera, we have a store in Faridabad. So we are very strategically placed where we know, because in every tier 1 city, there are people who are servicing the upper class. So those are our target customers. So, and a lot of stores in Delhi, they do better than national average also. So it's not like we don't want to expand in tier 1, but if we get a location that matches our cost structure, then definitely we're looking at tier 1 as well. But most of the expansion will come for tier 2 because when you're planning to open 100 stores every year, most of it has to be tier 2, tier 3.
Got it. And Akash, in terms of expansion towards the different trade channel, that is your e-commerce and quick commerce, because right now, if I'm not wrong, you're completely operating on the brick and mortar model, completely operating out of stores. Any plans with regards to expansion there, because that will give you a better reach and probably a better number of sales going ahead?
So online is a very tricky market for us because of such low ASPs. So our average selling price is only 300 rupees and our gross margins are also one of the lowest in the industry. So what we are working on is an omni-channel model where we'll use our existing store inventory to do online deliveries within the same city. So that really cuts down on the logistic cost and the return cost because then the customers can come and return at the store, they can pick up at the store. So it gives us a lot of flexibility because we want to be present online, but we don't want to burn money just adding another channel. So we want to have it as another channel for the existing customer base. So we have a customer base of more than 5 million customers, 50 million customers. So we want to leverage that data and cater to them in a different new channel.
Right. And Akash, in one of your con calls, I did read that one of the risks or potential challenges could be strong product development as well. How are you working towards that, and how do you plan to bring a leverage where competition is concerned? Because I'm sure that tier 2, tier 3 cities, there are other players which are competing with you in the same bracket. How do you plan to overcome that?
So we want to keep doing the good things that we've been doing. And in the last 2 years, the growth that we've shown has enabled us to be the market leader in our price segment. And in most of the locations that we are present in, we are at least 25 to 30% higher in terms of per square feet sale than our competitors. So that is a testament to our assortment, to our supply chain, and that the acceptability of the products is there. So we want to continue doing the good work and keep increasing the per square feet sales. So our first target was 1,000 rupees per square feet per month, and the next target is 1,200 rupees per square feet per month.
All right. And Akash, one last question before I let you go. 9 months FY25, you've already done over 1,300 crores of revenue, and the bottom line stands at, 66 crores. Where does that number go from here in FY26? What's the target like?
So every year we want at least 40 to 50% revenue growth. So you can calculate. So this year we'll close around 1,800 to 1,850 crores, and then going forward another 40 to 50% growth for the next 2 to 3 years.
All right. Well, thank you so much for breaking that down for us, Akash, and thank you so much for giving us those insights on the entire space as well as V2 retail. And thank you so much for taking our time.
Thank you for having me.
All right, so interesting company to watch out for, V2 Retail. Let's also pull up the SWOT analysis, that is the strength, weaknesses, threats and opportunities for the company. Let's pull out that metrics and see what are the strengths looking like for something like a V2 Retail. Now, in terms of strength, definitely presence in tier 2 and tier 3 cities is one of the strongest strengths that they have. Secondly, rural demand is picking up. Now, because they have a strong hold in the tier 2, tier 3 cities, rural demand picking up is definitely a positive for them, and overall operational metrics are on an increasing trend for the counter. So this is where the strengths are concerned. In terms of weaknesses, of course, market dynamics is one of the weakness where overall execution is concerned with respect to the market dynamics. That could be one of the weaknesses. Product development could be one of the weaknesses because they are catering to the low income group, and hence they cannot, after a given point of time, they cannot increase the average selling price. So they have to make sure that the prices are maintained, but at the same time quality is being maintained as well. In terms of brand positioning also, because competition is strong, that could be one of the weaknesses for something like a V2 retail. Now, in terms of opportunities, of course, global expansion could be one of the opportunities, but as the management said that it could be on the cards going forward, but they want to first establish a stronghold in India. Quick commerce, again, could be a good opportunity, but they've said that, they will cater to their own audience, which they already have, but not go to a newer audience. And overall, in terms of threat, competition from small players, of course, their peers like V-Mart Retail, Vishal Mega Mart, and of course, big fishes like Aditya Birla Fashion as well as Raymond Lifestyle could be potential competitors. But since they are operating in the lower income segment, the competition will come from something like a Vishal Mega Mart or a V-Mart. In terms of urban demand slowdown, if they plan to expand more in the urban cities, urban demand or tier 1 cities, urban demand is slowing down. And that is something which could kind of hamper the overall performance of the company. And lastly, changing consumer landscape is also something that could potentially impact the counter, because once the customer's preference changes, the inventory that they're holding might become obsolete and might put an overhang on the overall P&L. Lastly, in terms of an outlook and guidance that the company has given, they plan to add approximately 100 stores, as he mentioned, every year, and 40 more stores is something that they're guided to add in the second half. We'll have to wait and watch out for the total stores that they've added in second half of FY25. Also enhance the revenue from per square feet from 1,000 to 1,200. They plan to strengthen their manufacturing capabilities as well, and they're aiming for EBITDA of 120 crores in FY25. This is something the management has come out and guided. So this is the overall view of V2 retail, but with that, we're completely out of time on this edition of KYC. But do stay tuned to NDTV Profit for more news and updates on the other side.